Thank you very much for attending this webinar. We have three outstanding speakers today, two of them in Germany and the other one located, of course, in Mexico. So we have with us Dietrich Jacobs, CPA and tax advisor for international tax law at PKF Fasselt. Dietrich, thank you very much for being here and good morning for us. Good afternoon for you. We also have with us Martin Alejandro Weiss. Martin is a transfer pricing manager also at PKF Fasselt. And Martin, welcome to this webinar. And of course, I will be speaking with these two outstanding colleagues, Jimmy Cruz, head of the transfer pricing and valuations departments at PKF Mexico. Okay, when talking about adjustments, we will see in the next slide just a general description of the Mexican regulations concerning real and virtual adjustments. These adjustments, the real adjustments, have both tax and financial accounting effects. This means that they impact the financial statements of the company as well as the tax obligations. For example, if a company makes a real adjustment, it will need to reflect this change in its accounting records and its financial statements also. And it will also affect the company's taxable income, okay, and stated in the financial statements. And it would also affect, of course, all the real implications of the company in accounting and financial aspects. As for the virtual adjustments, okay, they only have a tax effect, and this adjustment do not have any impact on the financial accounting records. Essentially, a virtual adjustment is made solely for tax purposes to comply with transfer pricing regulations without altering the financial statements. So next slide, please. As we can see here, type of adjustments also included in the Mexican regulations, okay, could be voluntary or primary mainly. Voluntary adjustments are conducted before the annual income tax return is submitted, and primary adjustments are a consequence of a transfer pricing audit. So while voluntary adjustments are performed by the taxpayers by their will, okay, as they consider necessary to comply with the arm's length standard, in this case in Mexico, the primary adjustments is done by request and as a consequence of a transfer pricing audit conducted by the Mexican tax authorities. So these primary adjustments may have certain implications, such as the correlative adjustment, okay, and the correlative adjustment could be domestic or foreign, okay. Domestic, if the counterpart, related party, is located within Mexico, or foreign, if the related counterpart is located outside of Mexico. So it may have implications in other related parties located in other jurisdictions. Okay, so in the next slide, we can see just a general description of adjustments that increase the price and also adjustments that decrease the price. So from Mexican perspective, it's very possible that the taxpayers perform adjustments that increase the price so that they will increase in the same amount the profit level of the company operating in Mexico, or adjustments that decrease the price that could increase the deductions of the taxpayers. So please go ahead to the next slide, and then we will see a brief description of the adjustments according to the German regulations. Welcome. It's going to be Dietrich or Alejandro. You can go ahead, please. The microphones are yours.
Thank you very much, Jimmy, for this presentation. And to make things easy, to some extent, at least, or to a large extent, indeed, things are very similar in Germany. One should distinguish between compensatory adjustments or true-ups payments. They are sometimes also called, and transfer price corrections, on the other hand. I made a discrepancy in the wording. Sometimes they are all called adjustments, but a compensatory adjustment is agreed upon in advance. It is reflecting an agreement, a contractual clause between the involved entities in the different legislations. And in this clause, they agree that there should be some kind of retroactive transfer pricing adjustment in case certain rates or certain margins are not reached, which they deem to be in line with the dealing at arm's principle. Now, this compensatory adjustment is a real adjustment in the wording of the Mexican law, and it thus has an accounting and a tax effect both. A common example would be a year end adjustment, whereas it is also necessary that this compensatory adjustment is made before the filing of the tax return, as it is in Mexican law. A transfer price correction will take place if either such a clause in the agreement doesn't exist, or the parties don't follow such a clause. As a contradiction to the compensatory adjustment effect, such transfer price correction is only of virtual nature. That means it leads to the taxpayer's correct income, but it is not reflected in the financial statements, not in the tax accounting. It only is outside the tax balance sheet based on certain technical instruments on which we don't comment right now to make things easier. In the middle between compensatory adjustments and transfer pricing corrections, one sometimes mentions transfer pricing changes. That means the parties to a cross-border transaction could come to the conclusion that an agreed upon transfer price is not in line with the dealing at arm's length principle, and they just for that reason want to change the price for the future. This is a different aspect. Of course, this leads to a change in the effective transfer price, but no retroactive effect. On the other hand, of course, accounting and tax effects for the future. But this makes things easy. We concentrate on compensatory adjustments, meaning real adjustments on the one hand, and transfer price corrections, meaning virtual adjustments on the other hand. Next slide, please.
Thank you very much. Yes. We have some case studies and examples to make it easier to understand. Okay. So, and then in this slide, we are talking first about a voluntary adjustment, okay, between a Mexican and a German entity. as we said before, voluntary adjustment in Mexican transfer pricing regulations is a transfer pricing adjustment that refers to an adjustment made by the taxpayers, okay, that are in a related party transactions to be considered at market values. Okay, so first, we have the case of a Mexican entity. The type of the operation is a deduction for the German entity, and the type of transaction, okay, is an inventory sale from Mexico to Germany. The original amount of the transaction is 3.5 million USD, okay? And then we have an adjustments performed by the taxpayers to comply with the transfer pricing regulations in Mexico. So originally, we have sales of 3.5 million Mexican pesos, as we said, USD, as we said before. So we have cost of sales of 2.5 million and a corresponding gross profit of 1 million, right? Then we have operating expenses at the level of the Mexican entity of 200,000 USD, which yields an operating income of 800,000 USD. And in the end, we have a calculated gross margin of 28.5%. If we perform the transfer pricing study, then we come up with an interquartile range, okay, from 29 to 38, so that the company is slightly below the interquartile range. So a transfer pricing adjustment is needed. So this is done on a voluntary basis by the will of the taxpayers, okay, to be consistent with the arm's length standard. Then, after reviewing the figures, we can see that the Mexican taxpayers need to adjust, okay, or to perform a true-up to their revenue, so that sales are increased by 200,000 USD, and then adjusted sales are 3.7 million USD, with the consistent cost of sales that will yield a gross profit of 1.2 million, okay, USD. So increasing the gross margin to 34.29, okay, which is slightly close to the median. So the company is now within the interquartile range. This adjustment can be performed according to the Mexican regulations, right? And then we will see what happened on the other side of the border, okay?
Yes, and if you turn to the next slide, we will see that basically the two sides, meaning the Mexican law and the German law, match. If it's a real or compensatory adjustment in Mexican law, and the prerequisites of the real or compensatory adjustment are met in German law as well, then it will be recognized in the German financial and tax accounting. The payments will have to be made to adapt to the transfer, the dealing at arm's length compliance level. And the German entity will have to file the tax returns accordingly. If we turn to the next case study, however, we change to a virtual adjustment. And of course, Jimmy, it's first the Mexican side, because this is where the field auditor is located and wants to enhance the profitability of its domestic entity.
Exactly. Yes, here we have an example of a primary adjustment, right? And then, as we said before, primary adjustment refers to the initial correction made to the taxable income of a company to ensure that the intercompany transactions between related parties are priced at arm's length. This adjustment is crucial for aligning, okay, the reported profit with the economic reality of the transactions. So it is very important to state that a primary adjustment is a consequence of a transfer pricing audit by the tax authorities, right? In this case, by the Mexican tax authorities. So primary adjustments in this case is a revenue, okay, or an income for the German entity. In this case, we are supposing a deduction for the Mexican entity, and the type of transactions is the inventory purchase. Okay, so it's the purchase of inventory, which is a very common transaction between Mexico and Germany. Okay, so we have in the initial case, or in the initial scenario, that the tested party, the Mexican entity, has sales of 3.5 million USD with cost of sales of 2.5 million USD, and then we have a gross profit of 1 million. Then the gross margin of the entity is 28.5%, okay, which as a consequence of the request of the Mexican tax authorities needs to be adjusted, right? So they stipulate, the Mexican tax authorities, an adjustment of increase in the revenues of the Mexican entity. So going, okay, from cost of goods sold from 2.5 million to only 2.3 million, thus increasing the gross profit of the Mexican entity, okay, to 1.2 million USD, and therefore increasing the gross profit of the Mexican entity from 28% to 34%. Then this is a consequence, right, of a primary adjustment for a transfer pricing audit conducted by the Mexican tax authorities. Then we will see what happened on the other side of the border.
Yes, thank you. And this will be shown on the next slide. In this case, we made some assumption. We made the assumption that there's a German parent entity and a Mexican subsidiary. The sales are performed from the German parent entity to its Mexican subsidiary. As we learned, it is not at an arm's length level, but instead the price charged for this sale is $200,000 US dollars too high. That means in the original scenario, we assume a German tax profit from trade to be 4 million, leading to a 30% tax burden of 1.2 million currency units. But after the correction, which we assume will lead to a counter adjustment in Germany, the tax profit from trade, of course, is decreased by these mentioned 200,000 US dollars. However, as the German entity actually has received a consideration of 4 million US dollar, there's an additional tax item which is regarded as a deemed distribution received by the German parent entity. If both entities are a corporation type of entities and under further assumption, this deemed distribution will often be tax-free to a level of 95%. So the effective tax burden after this counter adjustment will be 1.1 and something million US dollar, and thus will be decreased. if we turn to the procedural point of view, of course, the trigger is the Mexican field audit leading to the primary adjustments, Jimmy, right?
Yes, yes. So for the primary adjustment, general procedure is that the tax authority determines the adjustment to decrease the transfer price, in this case, the deductions of the Mexican entity, and then it decreases the authorized deductions and files the Mexican company an amended tax return. The Mexican company notifies the German company of the adjustment, and then the German company applies the procedure according to the German law.
Yes, they will notify their domestic tax office. They will try to reach a counter adjustment, maybe by applying for a mutual agreement procedure. And we hope that such an agreement will be reached. And finally, the assessment notices will either be changed by the tax office automatically, or the German corporation will have to amend its tax returns accordingly.
So as we can see, adjustments are perfectly feasible according to Mexican and German regulations.
So they are feasible, not always that appreciated, let's say, in this case.
Not always that easy. Not always
not
that
always
easy,
that
right?
easy. Yes. So it's important to see that addressing double taxation in Germany, one needs to inform the tax authorities, both national and the foreign tax authorities. The company may seek corrections, discuss counter corrections with the foreign authorities. It's like we say always in transfer pricing. Once you establish the discussion with the tax authorities, so it's always a dance or a tennis match in which you always are playing the ball to the other court and it comes back. Of course, the company can apply to a mutual agreement procedure if no agreement is reached. That means that the tax authorities would need to speak one another in order to reach an agreement on this regard. What are the procedural guidelines? Once you submit the documents to tax authorities for the foreign correction, you need to document everything correspondingly in Germany. That means that if in the case of a transfer pricing adjustments, you need to be documenting the adjustment with some substance. In that regard, you will need to apply the benchmarking study, the comparables need to be, and we are foreseeing for this case that they are rock solid and unattackable by the German tax authority, and document any changes in the transfer pricing if they happen. One needs to know that that despite the German tax authority being very technical, they are also very open to some level of compromise. So once you start speaking with the tax authorities in the tax audit, they are likely to be willing to accept some kind of compromise. More willing when if it's on more on their side than yours, but some kind of compromise would be open. It's important also to focus that the high quality of the transfer pricing documentation is most valuable in Germany. So that would reduce the risk of further income adjustments and shorten also the tax audits. It's always on the burden of the proof lies with one. So, but the tax authority needs to rebut what you are stating. So, for example, in the benchmarking study, it's the job of the German tax authority to rebuttal it, to try to pick it out, and it's easier always to defend that than to attack it if your bases are strong. Next slide. Okay, now we go back to you.
Okay, we have some points to be taken into account for companies. In the next slide, we will see some points to be fulfilled by Mexican taxpayers. They may be, of course, a branch or a subsidiary of a foreign entity, okay, so that they can deduct the adjustments, even if they are voluntary or compensatory. So in first instance, they must have filled the tax returns properly, okay? They should obtain and retain, of course, the TP documentation, identifying that they are not in compliance, okay, with the arm's length principle. And then they should also obtain and retain a written statement by the expert, okay, or the author of the transfer pricing study, indicating that the company was in first instance in non-compliance of the arm's length standard in Mexico. So they also need to obtain and retain the same written statement signed off by the author of the transfer pricing study applying the transfer pricing methodology, okay, according with the Mexican income tax law, and also have the sign-off letter of the expert stating that the company is actually within the interquartile range after the adjustments. So they should also have the digital tax invoices of the original operation and also of the amended operation. And in the next slide, in this slide, okay, they should also comply with the documentation of the imports of the goods, okay, and documented that they have paid the VAT and any special taxes. And in real adjustment, they should issue the digital tax invoice covering the adjustment and so on. They also have to comply with the obligation, okay, to withhold and remit the income tax payable by third parties. So this is all points related with the to comply with deduction of transfer pricing adjustments in Mexico. So this is not really an easy topic. We understand that there are many aspects of transfer pricing adjustments that may be triggered on a daily basis by the taxpayers. But in general terms, we want to give the idea that the adjustments are possible, but taxpayers need to comply with certain rules in Mexico and also in Germany. Germany is one of the biggest partners of Mexico in the international trade, and as a foreign investor in Mexico is also one of the crucial countries for us. So that's why we have delivered this webinar concerning transfer pricing adjustments between Mexico and Germany. I will give the microphone to my colleagues for final remarks or final points. And so please go ahead, Dietrich and Alejandro.
Yes, thank you very much, Jimmy. I think the transfer pricing adjustments, corrections, changes, however you might call them, are really important because things change. Things change from the status when they are planned to reality. Margins might not be reached for different reasons. One might want to change agreements and amend agreements for different reasons. And furthermore, of course, the unlucky situation might evolve as well, that a few years after transaction has taken place, that there is some presumably better knowledge by the tax inspector, and then that he actually wants a primary adjustment, also triggering maybe secondary adjustments, that he assumes the chosen transfer price not to be in line with the dealing at arm's principle. However, that needn't be necessarily a threat. There are certain ways to rebut the arguments. Of course, if you are prepared for a tax audit, you have a good documentation on hand. But even if a change in the transfer price actually takes place due to the mechanisms of counter adjustments and possible preferential tax schemes for deemed dividends, might lead to a feasible tax burden all in all.
Thank you. Thank you very much. So we have some, we will open the microphones for some comments or questions if you wish.